And Roger, what do you think? Is this the beginning of the end of the ultra-loosening policy for Japan?
The market certainly thinks so, and I think that also might be the case. And the reason is that they're also starting to see a pickup in inflation. And the expectation next year in Japan is that inflation will be 2% or so. And if that proves to be the case, then the ultra-loose policy will have done its job and will no longer be necessary. So this might be the precursor towards a fundamental shift in a decades-old policy in Japan.
Yeah, you talk about inflation there being high. It's nothing like we see in most of the rest of the globe. But 3.8%, I think, was the latest read on a month-over-month basis. And that is incredibly hot when you're looking at a place that's had zero inflation for decades.
No, absolutely right. And the other thing to recognize is that this very low monetary policy stance in Japan has made Japan one of the largest exporters of capital to the rest of the world. Back in July, I think they were the largest owner of U.S. Treasuries in Japan at about $1 trillion. So the possibility that Japanese investors now get rewarded for keeping money at home has big impacts in fixed income markets around the world, and you're seeing that play out.
I mean, is that really the case? You're still talking about 0.4 something percent, but I guess that makes an excellent argument. Is it going to get much more expensive for us to finance our debt if the Japanese have other alternatives?
Much more may be too strong a word, but at the margin it will be more expensive, and at a point when other central banks are in action, obviously, and when there's great uncertainty. And so I think the real message here is a domestic message in Japan that maybe the ultra-loose policy is no longer appropriate. Yes, inflation is relatively low compared to the rest of the world, but relatively high compared to mild disinflation they've had. It also means that it's now worth keeping your yen at home, so to speak. And so this, at the margin, I think, Becky, is a bit of a change, and markets have reacted exactly that way. The other question, obviously, is, what does this mean? There's a new governor coming in next year. There was talk about changing the arrangements between the government and the central bank. So I think all of this sort of piles on to a degree of change and uncertainty in Japan that is rippling around the global markets.
All right, let's put on your former Fed, your vice chair of the Fed hat. What does the U.S. central bank think about this? Are they glad to see other banks moving in coordination, or are they concerned that Japan is not going to be there to sop up some of the U.S. treasuries at a time where they're looking to pull back from buying those U.S. treasuries, too?
Well, look, I think somewhere in the middle. So I wouldn't describe it as overly concerned. This is exactly at the margin. They will continue to keep their focus on the things that really do matter, which is domestic inflation. But yet, once again, you're seeing changes in financial conditions, which we've talked about many times here. And now, going from a dollar that was strengthening to a dollar that is weakening is, again, sort of loosening some financial conditions. So I look at this as sort of a marginal change, not a sea change, but something to be taken on board as they think through the number of moves that the Fed is going to make next year. Is it going to be 2, going to be 3, going to be 4? So I think they'll watch this closely as a small but not unimportant change to financial conditions globally, this time working through the dollar. And as you point out, the flip side is that it may increase at the margin borrowing costs for the U.S., and so that means interest rates here could be marginally somewhat higher. So you have two offsetting trends here vis-a-vis financial conditions that the Fed has been watching.